I'm joined by Samson Esemuede, MD of Zrosk Investment Management, to help me review some of the top stories. But before we get into that, we had some Q1 2024 financial results from Nigerian banks during the past week. First, we'll start with Access Holdings PLC, which grew gross earnings by 129% from 424.92 billion naira to 974.24 billion in the first quarter, while profit before tax stood at 202.7 billion and profit for the period standing at 159.29 billion. Guarantee Trust Holding Company PLC GTCO first quarter ended with a 685.9% jump in profit for the period to 457.13 billion from 58.16 billion in the first quarter of last year. UBA declared profit before tax of 156 billion in the first quarter of this year, up from the 61 billion declared in the first quarter of last year. Profit after tax was 143 billion compared with 53 billion in the same period in 2023. And finally, Zenith Bank PLC recorded a 270% growth in profit before tax for the first quarter to 320 billion from 86 billion in Q1 last year, with profit after tax at 258 billion, up 291% from the 66 billion recorded in Q1. Gross earnings grew by 189% to 780 billion in Q1 this year. Well, that's it for the banking results. Now let's join my guests in the studio. Samson, great to have you on the show. Thanks for coming on board. And since we're already talking about Nigerian banking results, let's look at another key sector of the Nigerian economy, oil.
Sure.
The oil production numbers are down.
Yeah.
What's going on? It's been 2 successive months of dips.
There are structural issues with regards to oil. I mean, this is an industry that has been underinvested in over the last decade and a half. Reports oil investments are down from the last one I saw from about $22 billion in 2014 to less than $6 billion in 2021. And typically, these fields have natural decline rates, which means that if you don't continue to invest, you have oil decline. And then layer on top of that the oil infrastructure that we have and these infrastructures were infrastructures that were built in the 50s and the 60s, and they have a lot of security weak points. And as such, a lot of this evacuation infrastructure has been compromised, and this is what has fueled the oil theft industry that is almost an organized crime, so to speak. And the amount, and once those infrastructure are breached, you need actual additional investments in order, and the IOCs, which control the bulk of our oil production, are not willing to make that investment. In fact, what you are actually seeing is that they are divesting out of their onshore and their nearshore and going deep offshore.
And we'll come to the divestment, but so you painted a picture where we're not replacing our reserves as much as we should because of underinvestment, but we also have security concerns and operational concerns, which are also hampering investment. So it's like a vicious cycle. What would be our lowest hanging fruit right now in terms of getting production back on board?
Well, from my understanding of the industry, a lot of onshore fields have been abandoned. IOCs have basically divested or abandoned onshore fields and infrastructure.
So when you say abandoned, help us understand, not divested to other players.
No, they haven't divested to other players, but once you have, for example, like the Nembe Creek line has been shut down for quite a while now, from what I understand. So the fields that you have that are feeding into those lines that is supposed to be to evacuate the product into Bonny where it gets exported cannot be operational. And what you're seeing over the years is that IOCs have left those fields in favor of the deeper offshore fields, which are more difficult to reach, and the fiscal terms on those fields are more attractive to them. And so they are reacting to an economic and security-related pressure.
Yes, certainly. And interestingly, our second story is on this acquisition by Seplat of the ExxonMobil upstream assets to the value of 1.28 billion, which has been awaiting approvals from the regulator and the like. How optimistic are you that that deal will close soon, and what impact do you think it will have on our production outlook?
It's been hanging. It's a deal that has been talked about for, I think, close to 2 years now. It's quite a shame and frankly a travesty that the deal hasn't been approved sooner. The reason I say that is that the global IOCs are facing pressure from their investors to go green.
Okay.
So the need to commit large billions of dollars into our oil fields is quite limited. I read an energy industry report which said that in order to increase our production from the current 1.3 million barrels to over 2 million barrels, we would need to spend approximately $7 billion in wells cost alone, and then probably another $2 to $3 billion in the infrastructure side, right? So that's $10 billion to get to 2 million barrels of production, and probably another $10 billion to get to 3. The IOCs are not spending the money. The indigenous players, right, are interested in acquiring some of those assets, but Seplat stands out in the sense that Seplat is probably the largest indigenous player that is listed in London, so have access to financial capital, and they can raise the sort of capital that is needed to grow the falling production, which we discussed earlier on. So this is a national priority for, in my opinion, for the government in order to incentivize more private sector, local indigenous participation in the oil industry and arrest this decline in production that we are seeing. So it's gone on for too long. So I wouldn't say I am optimistic, but the noise around it is increasing, and the regulators are beginning to talk about it. So I hope it gets done.
Indeed, and it's a very important point you make, because there have been some other recent acquisitions by indigenous players, which hopefully, well, we hope they won't go through this long, protracted approval process. Let's move on to some global stories now. The US Fed on rates, and Janet Yellen talking about the fact that inflation is down. A great thing for US consumers. But tell us about what the Fed's thinking around rates. Interest rates in the US are interesting to all of us because it impacts what happens elsewhere around the world.
So let's contextualize, right? Going into 2024, the global expectations from analysts and investors was that the Fed was going to cut rates by, the market was pricing 6, in some cases 7 rate cuts in 2024. That is on the back of high rates, weakening economic growth, and that was the expectation. And there were some talks that the US is going to get into a recession in 2024. That hasn't materialized, right? The US economy has been much stronger than expected. Analysts' forecast going into this year was that the US economic growth was going to come out at about 1.5%. It's trending around 2%, which is like a 30-year average trend growth. And that strength is largely driven by the service economy, which has been very strong because wages has been strong. And also, the US is also in the largest fiscal deficit. The fiscal deficits in the US are the largest it's been outside of recessions and wartime. So there's a lot of spending. The Inflation Reduction Act has resulted in massive investments in the US, which has kept growth up. Even things like the defense-related spending for Israel and Ukraine and Taiwan, a lot of that money is not going to leave the US because they're going to be given to US companies to provide those defense-related those defenses. So that continues to support the economy, which is why the economy has held up. On the inflation side, what is really interesting is that goods inflations have collapsed, right? If you look at the data over the last 30 years, goods inflation has been around 0, and then COVID came and scattered everything, and goods inflation accelerated. And it's now sort of back towards trending towards 0. The real problem has been service inflation, which has largely been driven by low unemployment, high wages. Service inflation is trending around, if you look at the last 3 months annualized, it's trending around 5%.
So, I mean, given that picture, you mentioned 6 or 7 rate cuts this year.
Yes.
That's now not likely to happen, or what do you reckon? Because I guess there's averaging out and balancing out of the blending of goods inflation, service inflation. Perhaps not quite at the target yet, but getting close enough. And jobs data not showing significant growth, right? So we may not see sort of the successive rate cuts that the markets had anticipated.
I think that's out of the cards. I think 6 rate cuts is out of the card. The jobs data yesterday that came out wasn't very strong, and that is why the market was quite optimistic that the rate cuts will be back. I think the US economy is still quite resilient. So there's even debates on the probability of a rate cut in 2024 at all. So my expectation is you probably get 1 or at best 2 rate cuts towards the back end of this year.
Thank you. So finally, very quickly before we wrap up, China electric vehicles. I mean, China is really, blazing a trail, if you like, in terms of trying to dominate market share for electric vehicles around the world. Tell us about what this dynamic means for EVs.
Well, China is the largest automobile consumer market in the world. And China has now become a net exporter of automobiles. In the first quarter of this year, China exported close to 6 million vehicles. This has significant implications because the European OEMs no longer can compete favorably in the Chinese markets, right? And China on the EV side is fully integrated as well across the value chain
in terms
right?
of raw materials and inputs.
Correct, yeah. Right? And if you look at the growth in vehicle sales in China, 50% of it is EV. And globally, I think China is the fastest growing EV supplier.
And then building the EV is much cheaper than other models.
At a significant, if you look at BYD, I think entry-level car for BYD, which is the largest EV player in China and the most known competitor to Tesla, for example, they are able to roll out EV vehicles for as cheap as $10,000.
Well, that's incredible.
Which for me, I think it's a threat to the global OEM, and I think the offshoot of that, and you will start to see that the market gates will start to come up, and the US and the European markets will be looking to preserve their hegemony in the auto manufacturing
Indeed,
space.
so we could see some new tariff wars, some trade wars really around, I guess.
It's quite plausible, but it feels like the cat is out of the bag. I think China is now closed a lot of the frontiers in terms of EV technology, and also the global south is also quite growing. So that gives China an opportunity to dominate the global south.
To dominate the global south, not just in terms of supplying EVs, but also raw materials. Look at some of these metals that are going into inputs for batteries and all of that for EVs. But yeah, Samson, we've run out of time. I wish we could talk a bit more, but great to have you on the show. Thanks for coming and offering your insights. That was Samson Esemuede, the MD of Zrosk Investment Management.